Okay, let's talk about mortgage rates. Where are they heading? Are they going up? Are they going down? What types of mortgages can we deal with? Is it a good time to perhaps break our mortgage or not? These are the questions I'm constantly getting. And in order to answer these questions, I really have to explain to you a little bit about mortgages and the types of mortgages that are out there. They're not as straightforward as they have been in the past. So I'm going to take a few minutes here to kind of explain to you what's been transpiring in the mortgage industry, and through that, hopefully you'll get a bit of an understanding as to what's going on. So we're going to look in particular at the variable mortgages and how we get those type of mortgage rates, and on the flip side, the fixed mortgages. They are both set differently, and they don't always work hand in hand with each other. Traditionally speaking, over the course of my adult years, we've typically gotten a bit of a discount on our variable mortgages for taking the risk that the rates may go up. Unfortunately, right now, there's a lot of people predicting they're going to go down. Hence, we're actually paying a bit of a premium for the variable rates. So let's kind of look at what's been going on here with the Bank of Canada Central Bank. They're the ones that kind of set the what we call the overnight rate. Currently, that is at 4.5%. And then the banks in general, like the TVs, the RBCs, the BMOs, they'll set their what they call their prime rate on top of the central bank's overnight rate. So right now, as I've indicated here, it's at 4.5, and as we have on the side here, it's at 6.7. They typically follow between 2 to 2.2% spread. So as the central bank drops the rates, they'll drop theirs accordingly, but I was staying about 2 to 2% above whatever the central bank's rates are. So right now, as you can see on the chart, the rates are significantly there. Now, with the inflation, there's a lot of talk about inflation, and looking at this little chart here, it shows you, traditionally speaking, the Bank of Canada has tried to keep inflation in around 2%. And we've done a really good job of it in past years, but unfortunately, it just shot up rather significantly, more or less this time last year. So as you can see here, thankfully, it did shoot up to a high of 8.1%, but with the significant rise in the overnight rate set by the central bank, we finally started to see it come down. And just today, I actually heard that we are down to about 4.3%, still above the 2% target, but this is great news, which is why, as I showed in that previous slide there, the Bank of Canada has finally stalled the constant increases in the central rate, and they've done a kind of a wait and see approach, which I think is great news, and I'm hoping to see these numbers drop even further. I know the predictions, as we indicated down here, is that next month we should see it drop down to 3.9. Keeping my fingers crossed, hoping that's exactly what transpires there. So now you have a bit of a sense for how the interest rates work from the variable side. We can kind of look at some of the mortgage rate sheets. So Marathon Mortgages is one of my preferred mortgage lenders. They often offer very competitive rates. I get these rate sheets all the time. So if you're looking here, you're going to see what we call the 5-year ARM, adjustable rate mortgage. Now, we're going to talk in this case about the adjustable or variable mortgages. There's some nuances, differences between the two, variable and adjustable, but the point is it does fluctuate as the central bank adjusts the rates. So right now, with this particular lender, for most mortgages, they're offering a 0.9% discount if you are what we call high ratio, so an insured mortgage, or if you've got 35% or more in equity in the property. Now, this is only for a purchase, or if you're switching from one lender to another. This is not for a refinance. Okay. Now I've kind of highlighted a couple boxes in the screen here to show currently the prime rate. This is the bank's prime rate is 6.7. Therefore, you'd get 0.9 off of that. You're looking at 5.8, which is where we've been for the last little bit since the Bank of Canada last increased the prime rates to the 4.5. Hence, the banks all followed suit with a 6.7 increase there. So that's kind of where we're at now. We have not really seen much in adjustments. There is some speculation within the industry that we will start to see the Bank of Canada drop those rates, but not until inflation has shown to subsided. It's really hard to say when this may happen. Some are hoping that the latter part of 2023, we might start to see the central bank drop its rate, in which case you'll want to be on a variable. But keep in mind, you're still going to be at 5.8, so it'll be 6.7 will get reduced to, let's say, 6.5, and then you'll go from your 5.8, 5.9 down to 5.6. So you're still going to be quite high there. On the flip side, there's the fixed mortgages, and traditionally speaking, many Canadians like to have the fixed the mortgages here. So Here, the fixed mortgages work really more on the bond market. Where are the bonds selling at? So recently, bond values have dropped, which has caused yields to go way up. So in essence, what that means is if you want to borrow money off a bond, you're going to have to pay more to borrow that money, which is why our fixed rates have gone up quite significantly, right in line with the variable mortgages. However, as you can see in this little chart I've indicated here, we've started to see those bond rates drop a little bit or kind of flatline, which is nice. And so, this gives you a bit of a sense where things have gone in the last, several years. As you can see, the bond yields were super low, but now they've increased quite significantly. Yeah. So going here, when we look at the mortgage rate sheet, I've actually used the same lender in this case, and now I'm looking at the fixed side as opposed to the variable side. There's a few key items we look at. We look at term, which means how long is this mortgage going to be? And as we can see here, I've highlighted we got the 2-year, 3-year, 4-year, and 5-year terms. Unfortunately, the lenders are of the mindset that the rates are going to be going up. So they really would love for you to lock into a 5-year rate. But of course, you don't necessarily want to do that if you think the rates are going to be going down. So in order to encourage people to get on board with a 5-year rate, the lenders have finally started to drop those rates. And as you can see here, we've got a 60-day rate hold with this particular lender, one of the best ones I've seen in a very long time at 4.99 on, a 4.44 on a 5-year fixed. Which is great. I mean, back around November, December, all of my 5-year rates were over 5%. So to see it come down this low, and it's been dropping quite steadily. The thought process is that they have a lot of money in their system. They're trying to get it out there, and they want to get locked in for a 5-year term. That being said, a lot of people are coming to me and say, Dan, you know what? I think they're going to drop lower. I don't want to pay the 5.7, 5.8 on the variable side, and I don't think the Bank of Canada is going to be dropping the rates in the next year or so. So I want to do a lock-in option based on the bond market. Unfortunately, as you can see in this chart here, the bond market is still charging in around for short term. This example here, and this is actually one of the better ones at 5.49 for a 2-year. Quite nice at the 3-year. So for a lot of my clients, we're opting to take that 3-year option so we can kind of get the best of both worlds, a little bit lower on the rate than the 2-year, but not as high as the variable for the time being. And that's kind of a tough one. People have to decide what they want to go with there. The other thing we look at is the equity. How much value is there in the home? So as I mentioned, if you've got 35% or more equity in the home, and that'll be done via an appraiser, an appraiser, not one you pick, one the lender picks, then you can get yourself a better rate than, let's say, you only had 10 or let's say 25% value in the home. On the flip side, if you were what we call high ratio mortgage, if you had the insurance, CMHC, Genworth mortgage insurance on the home, they'll give you the exact same rate as the person who has 35% or more equity. The reason being is that the lenders are not as concerned about losing money on the mortgage. Hence, they would prefer your piece of business versus somebody else. The more equity there is in the home, or the fact that there's an insurance policy on the mortgage, means that the lender most likely will not lose their money. Worst case scenario, you stop paying your mortgage payments, they will reach out to the insurer, call in, say this is now your problem, you pay us back our money, hence utilizing that premium. On the flip side, if you've got 35% equity in the home, they will foreclose on the house, they will sell it, but before any of their money starts to dissipate via perhaps a drop in value on the home or legal expenses, real estate costs, whatever else, that will all come from the proceeds of the current owner's home, hence the 35%. So there's that safeguard aspect to it there. And then we've got the last thing is what we call the rate hold. Typically, anything that the lender offers you in your favor, so the longer they'll offer you a rate hold, in this case a 60-day or a 90-day, they'll give you a better rate. Part of the reason being is that lenders have pools of money that they have to get out. They do not want to let it sit in their accounts. They want to get it lent out as quickly as possible. And so by doing to encourage people to take on perhaps a quick 60-day rate, they'll say, hey, here's your mortgage rate, which they can't normally offer. Or in this case, 90-day, not quite as attractive of a rate, but not bad there. We're looking just a measly 0.05, but these are some of the specials that we often get to come across our desk as mortgage agents. So always a good idea to kind of keep me apprised of what you've got going on there, and by all means, we can, if you want that peace of mind, we can lock you into with some lenders, not this particular lender, but other lenders, we can do up to 120-day lock-in, and other clients say, let's just hold on, Dan, and maybe we can take advantage of one of these 60-day rate holds. Okay. Yeah, so when we're looking at the fixed versus the variable mortgages, a outside of the interest rate, the other thing to consider is what are my payments going to be. So I've kind of ran a couple scenarios here just to give you a real life example as to how this would play out. In both scenarios, I've gone ahead and assumed a 10% down on the home. You're buying a house in around $500,000, hence you're going to get yourself a mortgage of $450,000. Because it's less than 20% down, you are going to be responsible for paying the CMHC or Genworth premiums. So I've indicated that kind of in the bottom right hand of this screen here. So you're looking at a total mortgage of $463,950. The payments on something like that would be $2,932 on a variable, assuming a 5.8% rate, which is more or less one of the more competitive rates being offered. This is a 5-year rate to get something like that. Now, keep in mind, even though that may sound like a lot, you're paying $2,932. You are actually paying down that mortgage quite significantly. So at the end of the 5-year period, your mortgage will go from $463 down to $416. So you've paid off quite a bit by taking advantage of that, buying a home as opposed to perhaps renting. So at $2,932, I have another calculator that can do a great job of showing you how much of that $2,932 is actually going towards principal. Roughly speaking, it's about a third of it is going towards principal. That does fluctuate as time goes on, and by all means, reach out to me and I can show you other calculators that show that. On the flip side, clients say, well, at the end, I don't want to pay a 5.8. That's a really high, and yeah, I don't think it's going to be dropping. So on the flip side, I've got another scenario here, taking the 5-year rate, and I do know some clients are in a situation now where they just can't keep up the payments. That's an extra, in this case, we're looking almost $400 difference by going with the 5-year versus the variable. So if that's your situation, you're having a hard time keeping up with your payments, give me a call. Perhaps we can switch you to another lender, get you into a 5-year fixed, and it's still not the best rate. But that being said, it's not always about rate. It's about what are my monthly obligations. If you have $400 more in your pocket that you can enjoy spending time with your family and loved ones and just enjoying life in general, going to the baseball games and out on the weekends, then perhaps that's the better option for you. But as we indicated in the previous one there, your mortgage at the end of the term will be, actually lower as well. So that's another one of the advantages by, going with the lower, the higher rate. That being said, keep in mind the 5.8 on the variable may drop as the Bank of Canada finally starts to drop rates next year. Whereas, it's highly you won't be changing this rate. You will be stuck at these payments for the duration of the 5 years. Nice thing is you will know at the end that your mortgage will be at $407, as we indicated on the bottom right-hand side there. So that's one of the nice advantages of going with a fixed rate. You kind of know how things are going to play out for the next 5 years. There's no ifs, ands, whats about it. So there you have it. Fixed versus variable. Where are they going? We're not entirely sure, but that's kind of the inside scoop as to where we think things are going to go. This does change from week to week, month to month, depending on things like I mentioned, the inflation numbers. So by all means, if you're kind of curious, you got a mortgage coming due, you have a friend who's got something coming due, give me a call and I'll give you my 2 cents, let you know where I think things are going. And like I said before, it's not always about the rate. It's often, for many of my clients, more about their monthly obligations. So we need to talk about this. If you're going to be in a bit of a spot, rather than foreclosing on your home, perhaps that's when you got to give me a call, and we can see if there's some options available for you. There are a lot more other options available outside this. This is just our fixed and our variable. And in both cases, I've gone ahead with a 25-year amortization. But there are a plethora of other options that we can do. We can extend these mortgages over a longer period of time and see how those numbers work out. Hope this is helpful. Have yourself a great day.